Hello, this is Vince over at Plum Creek Funding and ColoradoMortgageGuy.com. Again, I'm here to give you some exciting information on making the decision and reaching that milestone about wanting to purchase a house. Whether you've owned a house before or whether you're buying your first house, there are a couple things that we need to take a look at. So remember, I've always said that there's only three things that go into buying a house. That is your credit score, your monthly income, and your down payment. So today we're going to talk about credit scores, and we're going to talk about how much money down will impact the type of mortgage insurance that you have. Okay, so there's basically going to be 3 to 4 different types of mortgages. Number 1 is an FHA loan. Number 2 is a conventional loan. Number 3, if you are a veteran, then you are going to be approved VA and you'll have your veteran certificate of eligibility. And number 4 is something called USDA. It's for rural properties. So let's talk about FHA first. The credit score that we're looking for an FHA loan is a 580 credit score. The minimum down that you have to have is 3.5%, and we can go from a 45% housing ratio, which is just your house only, to a 55%. The next type of loan is called a conventional loan. The conventional loan, we were looking for a minimum credit score of about 680. And you can go anywhere from 3% down to 5% down to 10% down to 15% down, and then 20%, 25% down. The debt ratios that we're looking for on a conventional loan are starting with just the house, 45%, and then the total housing ratio around 49%. On a VA loan, we usually like to see credit scores around 600. Now, there is no money down, and the ratios that we want to see are a 45% front end, which is your housing ratio only, or a 49% total debt to income ratio. Then we have the USDA. USDA again is for rural properties. There is zero money down required. That is zero money down required for USDA loans. And the ratios are going to be a little bit stricter though, and the income is also tapped. So the housing ratio alone, the USDA underwriters like to see around a 29% debt to income ratio. Your total housing ratio cannot exceed 41%. So with USDA, they're going to look at your income, and they're also going to look at your entire household income. So we're going to analyze everything when doing a USDA loan. With USDA, we are looking for that total housing ratio to be around a 41%. So we are going to really look at your entire household income because there are income caps on the USDA loans. So again, there's basically 4 mortgages that a person can qualify for. Mortgage types. You have your FHA mortgage, you have your conventional mortgage, you have your VA mortgage, and you have your USDA loans. Again, what it takes is teamwork to get a person through the loan process. The mortgage industry is not rocket science. And this is Vince Reese, Colorado Mortgage Guy, powered by Plum Creek Funding. Phone number 303-818-0699. That's 303-818-0699. I look forward to you seeing my next videos, which will be on mortgage insurance.